Hey, welcome everyone. Tom here from Park Avenue Trading. I want to bid you a good hello. Please, if you like what you see, like, subscribe. Don't forget to ring the bell so that you don't miss out any of my important information that I'm going to give you. Today we're going to discuss something that I call market structure. Okay, I had a conversation with a friend of mine the other day in the cigar shop, and he was asking me, so how do you formulate your trade ideas? You say you're a technical trader, so you only use technical analysis, correct? And primarily I do. I generally just use technical analysis. However, I would be a fool to dismiss fundamentals. And there are certain ways that I look at fundamentals, and I know that fundamentals are always playing in the background. And I'm going to keep this video kind of short. I'm just going to give a couple examples in what I consider to be the market structure itself. And the first thing I want to say is that, and I'm looking at sterling yen because I got a trade on it, sterling yen, where I'm really a little angry with myself because I took half my position on instead of my full position on at a trade call that I should have done full. And I don't know why I didn't do that, but I put a trade call out in a telegram. It would be long sterling yen, 195.53, and I was looking to buy my other half at around 195.35. Real stupid. Now it's trading at 196.08, and then I was looking to buy another half at like 60. That didn't happen. So now I got half my position on and a marketplace that is going in my direction. But that's for another time. But market structure, okay? And this might be a little bit boring for some people, so I'll try to make it as exciting as I possibly can. The way you find out about market structure is, or what the fat pigs, the fat cats are thinking. Is you read Barron's, you read the Wall Street Journal, you read The Economist. Now, The Economist is probably one of the most important magazines that you could look at and read, and because that is basically the magazine of Davos. That is the magazine of the regime. That is the writings of what they want to happen or what they're thinking is going to happen. Now, with that said, you read these you read the paper, you read The Economist, but you read it in a way that you don't believe everything that is written. I mean, you have to understand that a lot of it is wishful thinking on their part. Now, they do get about 80% of what they want to happen generally happens. 20% of it doesn't. Now, aside from that, so how can we take all this data and how can we assimilate this data into the underlying market structure? So I'm going to give you an example. Back in 2019, okay, 2019, 5 years ago, okay, the 5-year Treasury yield was 1.5%. The dividend yield on the S&P was 2.8%. Now, given the yield advantage in equities, okay, the money was going to flow into equities because the yield in treasuries wasn't good enough for the fat cats. So the big guys are always in search of yield. That's what they're interested in. They're not so much interested in speculation. They're more interested in yield. Where can I put my money to get the biggest yield with the least amount of risk? So equities are riskier, yet when the yield advantage is such that the equities they become less risky to what treasuries are. So in that environment in 2019 and moving forward, it was really, really challenging to be short the S&P. So what you should have been doing then, just by having that information, is you should have been looking to buy the S&P on dips because the fundamentals were there. So if we talked about band trading in the last video that I put out. So that's a good example. You could go back and look at the S&P from 2017 on to today. You could put your bands up and you could basically say, now having the market structure, the knowledge of the market structure, you wouldn't be looking to be selling lower bands. you'd be looking for the market to come back down to those lower bands. And now we're talking about a longer time frame. Okay, you could use dailies. You could even use, you could use 4-hour charts, things like that. That would probably be significantly better than looking at a 1-minute chart. But the idea is that you had the market structure, or the market narrative was there for you to see that the yield was nothing, as far as U.S. Treasuries, 5-year Treasuries is concerned, compared to what the yield in the S&P was. So, and you could Google that. You could Google current, market yield 5-year Treasury, current yield in the S&P. And what you're going to find out now today is May 13th, Monday, May 13th, 2024. And remember, the big boys are always looking to chase yield. Okay, so that's where the money is. That's where the big money is. And then, before I go on, like what causes these major corrections? Like, for instance, sterling yen. If I go to sterling yen, we'll just take sterling yen. Let's go to the weekly. Okay, and I crunch this down. Okay. Sterling yen just 3 weeks ago reached a high that we haven't seen in like 2010. It was like 200.56. It reached the high of, and then on that same week it crashed back down to a low of 191.37. Now at that point, the market structure didn't change. No interest rates changed in sterling. No interest rates changed in the yen itself. So therefore, this was a perfect opportunity to pick your points technically, to find out where the fat cats were getting, they're going to buy it eventually. I mean, now, of course, you have to have stop losses at all times, because you just don't know how much further a market irrationality could go. Markets are irrational, and that's the reason why we can make money, because people become irrational. Now, the main thing that you need to understand as a trader is that it does take a little work to do this. You need to do maybe 30 minutes a day of research to make sure nothing has changed. Then you need to be basically formulating in your mind what could change, like what news could come out that would have a tremendous shift in what the market structure is. And I'm going to propose one of those in a moment, like what I've been thinking about on a weekend, this previous weekend, what I thought about this weekend. And then also in the next series, I'm going to go over basically how I go over my trades against what the market narrative is. The market, or the market structure is. It doesn't change too much, but there are significant events that could occur that could really shake the structure of the marketplace. So today, as of 5/13/2024, the market structure is quite different. The Treasury notes are yielding 4.52% on a 5-year basis. That's a significant difference than 2019. We're in a rising interest rate environment right now due to inflationary pressures of the economy itself. The dividend yield on the S&P is at 1.35%. That's extremely low. Now, the historical average is 1.87%, so it's even below the historical average. Remember, back in 2019, I said it was like 2.8% yield. So therefore, it was a great yield. It was a great trade to be long equities. Right now, what the market structure is basically saying is that the market is overvalued. If you're looking at just these numbers, the market is totally overvalued, and money flows are going to go into treasuries. So therefore, it's going to be really challenging to be long equities at this time. So therefore, technically, you should be looking for places to sell equities, because that's where the money flow is going to be. Money flow is going to be, get me out of this shit so that I can get, I could take my money out and go into, treasuries or gold, or, now gold is a different animal itself altogether, because gold basically is a zero interest rate bearing instrument. However, you use gold as a means of protecting against inflation, and this is an inflationary environment, so therefore gold continues to rise because of this. That money flows, portfolio managers are breaking things up. They're going into treasuries, yet they're going into gold as well as a hedge, speculative hedge. They won't probably put that much money in gold. They'll do a percentage of their portfolio, all based on the profile structure of their investors. So what could cause a dramatic shift in the market structure itself? And I've been thinking about this, and I'm going to make a statement that, this is just because I'm trying to formulate every different angle that could possibly happen so that I could take advantage of the movements. Now, I also say with both sides of my mouth that if what I'm thinking, if a major event happens and what I'm thinking doesn't come to fruition and the market's going the other way, well, that's a major, major trend change signal. Or, majorly, you're wrong. Most likely it's going the other way big, and it's going to go the other way big for a while. Okay? So what is one of these scenarios that I've been thinking about? Now, regardless of what you think about Donald Trump, right now, many people think that what's going on in New York with these trials that could have happened years ago, that basically nobody actually knows what the exact crime is. But they have this man on trial, and it's looked at as a political trial. It's looked at as a means of knocking him down a few notches so that, he doesn't become president of the United States again. Because the fat cats don't want that. They want to keep things basically the same. And we can make money in any environment, but here's the thing. As a thought experiment, I said, what would happen if they put this guy in jail? Worst case scenario, they say, you know what? You're guilty. You're going to jail. What would happen? What would the world think? Who's going to buy U.S. treasuries if they start to believe that the United States is no longer a democratic republic? What's going to happen with gold? What will happen with foreign currencies, the fiat currencies? I would suggest that I would be long sterling straight large if that ever happened. I would be long the euro large if that ever happened. I'd be looking even to get long the yen if that happened. Maybe I would be staying my sterling yen cross, but also have basically another piece of sterling on itself. Because if something like that was to happen, the shift would be so dramatic. It would be that the world looking at the United States like, what does the United States become? Is it become just like a third world country? And I'm not saying either way, whether you like the guy or not. You got to look at the implications of what the market will do, what the other countries will think. I thought also that, I was reading a while back where they were thinking that they were going to steal Russian assets and send them to the Ukraine. That's insanity. So basically they're saying the United States will rob your bank, and give it to somebody else. These are some serious things to ponder. And it's, again, regardless of what you think about, Donald Trump, it's just like the consequences. This has never occurred in the United States before, and this is definitely a fork in the road, and it's something that these are the thought experiments that I have in order to try to prepare myself for like the worst case scenario. Like, what will I do? Okay, how am I going to capitalize on this? And the way I would capitalize on it is I would go long I would go long everything against the dollar. The dollar's under pressure as it is anyway. Will the dollar still remain the reserve currency of the world? That's a question. if things keep going the way they're going, no, the dollar will not, because the United States being on the bully pulpit saying that if you don't do things the way that we want you to do them, you're not going to be able to use our financial markets. And some of the world is saying, who cares? F you. We don't need your financial markets. We'll have our own financial markets. And China and Russia are working towards that with the BRICS countries and everything else. So I'll leave that here. So basically, we just talked about market structure. And we talked about how you should be looking at The Economist, you should be looking at the Wall Street Journal, the Investor's Business Daily. You should be looking at 5-yield Treasury yield versus what the current yield is for the S&P. That's great for equities, but it also falls off into currencies as well. So, I'm shocked that the sterling hasn't really rallied that much. Compared to the dollar. I would expect sterling dollar to start to move higher. But then again, they are really in the same boat as the United States, kind of, so to speak. The euro dollar itself as well. It's going to have to be a significant shake-up to break off the interest rate differential equation, the carry trade equation. But I am cautiously optimistic about sterling, and I'll definitely take sterling over the yen. So I'll take that trade on any dip that I can get right now, and it's working out quite well for the day. Unfortunately, I don't have the full amount on. So I look forward to talking to you guys again. Please, if you like what you see, don't forget to subscribe, hit the like button, ring the bell, and I'll see you on the next side. Cheers.